Okay, welcome everyone. My name is Neal Trup. I'm a chartered accountant, and I've been supporting grantees on youth investment funds. Um, and this session is about helping you understand the auditing and accounting requirements, because there's so many complications around them. We thought that this session would help hopefully to make things a little clearer. And you can see just from that slide, there's all sorts of terms that are sort of thrown around: audit, SOR, accountant reports, receipts and payments, independent examination, and so on. And what I'm going to try and do here is explain it carefully, and with some examples, because that will bring it out. And in particular, the reason it is quite complex is because 2026 is a year of change, and quite significant change. And the two main changes that are happening is that there are new accounting and reporting requirements for charities and indeed for companies more widely. And that is for accounting periods beginning on or after the 1st of January. So if your accounting period began from that date onwards, then you would be impacted by the new requirements. And there's also new charity independent examination audit thresholds, and they're coming in for accounting periods ending on or after 30th of September 2026. So you can see some organisations in their current year won't be affected by either. Some will be affected by one of these changes. Some will be affected by both of the changes. So it will depend upon the type of organisation you are and also the date of your year end. So what I've done for this session, just to help you, looking at the MMC grantees cohort, I've broken this down into three sort of like legal forms, because the requirements do differ across these forms. So we're going to talk about charities. So we're talking charity companies, CIOs, unincorporated associations, and also charitable community benefit societies. So if you're a charity, then these rules apply, which I'll come on to. If you're not a charity, but you're a company, so we're talking about companies limited by guarantee, community interest companies, or private limited companies more generally, then a different approach applies. And community benefit societies, so we're talking not the charitable ones, but the other ones, community benefit societies and previously registered societies, come under a different sort of rules or approach. So I'm going to start with charities step by step. So there are three steps here. Firstly, you need to calculate your gross income and assets, and I'm going to go through these steps in more detail. And that will help towards, your deciding what type of accounts you need to do. And I'm going to go through all of that. And step three is about what external scrutiny. So we're talking about independent examination, audit, or in some very small cases, not at all. And those are the things that we're going to go through in more detail. So this slide here is step one for charities. And the first thing on the left-hand side of the slide is about looking at your gross income for the period. And that basically covers all the income for the accounting period. And critically, it includes capital grants, which are considered receivable. I'll go into an example of that. But if the grant is received or receivable, within that accounting period, then it goes in at that accounting period. No proportioning or anything. It's just what is receivable. It also includes in-kind donations or in-kind sort of, it could be use of premises, it could be in-kind goods and services, but it does exclude any gains on valuation of assets or the sale of fixed assets or on investments. And then the gross assets for the definition is where you look at your fixed assets plus your current assets. So no netting off of any liabilities or loans or anything, simply your fixed assets plus your current assets. Now, to give you some examples here, so let's say a grantee receives £800,000 and it's split into two equal payments of June and September, for example, this example. Now, in example one, if your year end is 31st of March, then in this particular example, the whole 800,000 is included in the year to 31st of March 27. It's sort of straightforward. It's receivable within that period, and it goes in there. And that's a significant amount. That's your income that will be counted towards what accounts you use and also what audit threshold you use. But in example two, let's say the charity has a year end of 30th of June. In this case, the June payment is receivable in the year to 30th of June 2026, and the September payment is in the year to 30th of June 2027. So in this case, we've split it 400 in each year, and you can see that results in a significantly lower gross income simply because of the dates and your year end. So the year end is really crucial. So once we've got our gross assets and our gross income, we can look at the type of accounts. And basically, there's two types of accounts for charities. There is the accruals accounts, these are the company style accounts. And then you've got the receipts and payments, which are cash-based accounts. Now, I said 2026 was a year of change. So with the accrual accounts, you're either following what's called SORT 2019 or the new SORT 2026. And that depends on the accounting period, as I said earlier. If the accounting period began before 1st of January 2026, so if you're a March year end, March 2026 accounts have to be under SORT 19. But if your accounting period began on or after 1st of January 2026, usually December 26 onwards, then you would be under SORT 2026. And there's quite some significant changes. So it's very important to be clear about which framework that you need to follow. And just to go into a little bit more detail here, so what accounts need to be prepared? So we'll talk about, if we start with company charities and charitable community benefit societies. So for accounting period beginning before the 1st of January 26, then SORT 19, and if your accounting period began on or after 1st of January 2026, SORT 2026. Now you can see here, I will cover it a little bit later, but there are slightly different requirements in SORT 19. There are different requirements between what they call smaller charities and larger charities, and that threshold's at £500,000. Under SORT 2026, we've got these tiers, tier 1, tier 2, and tier 3 to consider. And then you've got CIOs and unincorporated charities. So if the income, your total gross income is 250,000 for financial years ending before the 30th of September, then you can use receipts and payments accounts. If it's from 30th of September, so that's ending. So I'll give you some examples in a minute. Then the threshold goes up to £500,000. If you're above those thresholds, then you must follow the relevant SORT accounts, just like company. So these are some examples. So let's say we have a charity company with a year end of 31st of March. For its year ended 31st of March 26, it has to use SORT 19. And for year ended 31st of March 27, it has to use SORT 26. Another example is CIO, so not a company. It has a year end of 30th of June. And in the year to 30th of June 2026, it can prepare receipts and payments accounts if its income and receipts is not more than 250,000. Otherwise, it needs to use SORT 19. Now, we have a CIO with a year end of 30th of September. So for year to 30th September 2026, it can prepare receipts and payments account if income is not more than 500,000. Otherwise, SORT 19 accounts are required. And here we have a charity company with a year end of 31st of December. And for that year to December 26, it needs to use SORT 2026. So you can see how much the date as well as the form of the company can make a difference as to what needs to be prepared. And then we move on to step 3, which is about the external scrutiny. So we're talking audit, independent examination. On the left-hand side of the slide, you can see the new and existing thresholds. And these apply to, the new ones apply to accounting periods ending 30th of September 2026 onwards. So you may already be in that period. Key ones I've put on here, there are about 20 or 25, I think, threshold changes. But these are the main ones I wanted to point out here. Independent examination was not required below 25,000. That's going up to 40. Some big changes is around qualification requirements for independent examiners. At the moment, you must have a qualified independent examiner if income is more than 1 million. That's increasing to 500,000. And in terms of audit, the audit of larger accounts is currently 1 million, and that's moving up to 1.5 million. And then there's also an asset test for charities that might be have lower income but have a significant amount of assets. That threshold is changing from 3.26 to 5 million. And just to give you some examples here, charity with year end at 31st of March. Okay, so for the year to 31st of March, the audit threshold is where the income is above 1 million. So if that's the case, then you need an audit. Or the assets test is if your income was above 250 and your assets exceeded 3.26 million. For the year to 31st of March 2027, the audit threshold is now 1.5 million. And I think for some organisations, MMC and others, that might actually be helpful that the audit threshold has gone up quite a bit. Again, for accounting periods beginning from 30th September onwards, so it might already be in the current financial year. And a CIO example, year in 30th September, the audit threshold is increased to 1.5. So that's sort of in the current financial year. And just a brief recap, what's the difference between independent examination and audit? So independent examination is a more proportionate, lower level of external scrutiny than an audit. It works on the basis of what's called negative assurance. So the independent examiner is not saying these accounts are true and fair or correct. It's more about reporting any issues that come to their attention. So if I was an independent examiner, I was saying I haven't found major problems in compliance and so on. But I'm not saying they're right. I'm saying I haven't found any major errors or problems and so on. And so it's sort of more proportional, whereas an auditor will be saying these accounts are full fair and there's a lot more work that goes into it. So independent examination is usually significantly lower cost, probably about a third of the cost. I mean, it will depend on the complexity of the charity, and an audit is a lot more involved. One thing I wanted to say before I move on to non-charities is that there is a possibility to apply to the Charity Commission to have an independent examination instead of an audit where you've got a particular situation that has pushed you over the audit threshold on an exceptional basis, a one-off basis. And I know at least one case of a YIF grantee who has done that, where they have applied to the Charity Commission, the YIF grant put them over the audit threshold. Um, they've had to give quite a lot of information to the Charity Commission to reassure them about financial controls, that it's one-off and their sort of particular, plans and so on. But it has been granted. It was a one-off, but the Charity Commissioner said, well, you've exceeded the audit threshold and you can do an examination instead. You must state it in the accounts that you have done this. It is a possibility, but it doesn't mean it's certain that you would get it, and you'd have to go through quite a few hoops to do it. But I just wanted to share that it is a possibility, if that was relevant. Um, so now I'm going to move on to CICs and non-charity companies limited by guarantee. Again, I've got this three-step process: calculating the gross income and assets, looking at the type of accounts, and the external scrutiny. But it does differ, as you'll see as we go through. So the first thing is around about gross income. It does differ from charities, whereas with charities, with like the capital grants, they are based on a received and receivable basis. With companies, CICs, you take a different approach. You look at the overall useful life of the asset, and you spread the income over the useful life of the asset. So it will make the amount of income from the capital grant that goes into the calculation significantly less. I'll show you in a minute with the examples. And you still exclude gains on, revaluation, sale of fixed assets, and so on. The gross assets, same calculation, fixed assets and current assets adding together with no netting. So to give you an example of a CIC, so it receives also the MMC grant, 800,000. So it's the same sort of grant, and it's still split between June and September. And the useful life of the asset is expected to be 20 years. And the building is completed and open from 1st of October 2026. So that's a crucial date when you're calculating the useful life of the asset. So in this example, the financial year end is 31st of March. And at that date, right, the building, your next year end, so 31st March 2027, the building would have only been open for half a year out of the 20 years that we've expected for the asset. So what we have to do is effectively put in only half a year, it's like 1/40 effectively of the 800,000. And so only 20,000 is put into the year 31st of March 2027. There's a very little impact really on the gross income for a CIC, very different to where we're lumping it in for charity. An example for here we've got is that CIC has a year at the 30th of June. So at 30th of June, nothing's included. So even though we've received the money, it's just treated as a deferred sort of income because the building isn't open. And in the year to 30th of June 2027, we're putting 30,000 in, and that's because we're only open 9 months of the year. Beyond that, it would be 40,000 a year. So it's quite a different approach here. So once we've done all the income calculation and the assets calculation, we look into what type of accounts can CICs prepare. Now, all of these are subject to your constitution. It might say in the CIC that it has to follow FRS 102, but usually it won't specify it. But if it does, then you need to take account of that. But this is the statutory position where there isn't anything specified. So small companies use what's called FRS 102. And again, you need to look at the accounting period implementation date. And like SORP 19, this comes in for accounting periods, or this is already in place for accounting period before 1st of January, and the new FRS 102 accounting periods beginning from January 2026. And there are, again, quite a few new requirements, very similar to the SORP. Now, some organizations might use micro entities or FRS 105. Again, the same implementation dates between, around 1st of January 2026, but these are very simplified accounts. And you can see the thresholds here are with income below 632,000, gross assets up to 316, and up to 10 employees. And you've got these three measures, and you've got to meet these three measures for 2 years running. Two of the three measures for 2 years running. Again, not always easy to sort of work out, but these are more basic type of accounts, but they're also changing to some degree. So just, again, moving on to some examples here. So, these new requirements of FRS 102, 105 do bring in new accounting requirements, including putting leases on the balance sheet, which would be on SORP, and changes to income recognition. Won't really affect the MMC grant at all, because that's more about business type income changes. But to give you an example, CIC with year end of 31st of March. So the year to 31st of March 2026, it needs to use the older standards, FRS 102 or 105. And for year to 31st March 2027, it needs to use the new standards. And the CIC year ended 31st of December, so the year to 31st of December 2026, we need to use the new requirements. So already within the year, you're already, in fact, both of them are now within the new requirements. And just don't forget, CICs also need to file what's called a CIC 34 report. It's a sort of it's a little bit like a form just explaining the activities of the organisation of the year. So now we move to step 3. We move to step 3 for CICs and other non-charity companies. And you can see here the thresholds are very, very much larger than for charities. And again, it's 2 of 3 to be exceeded for 2 consecutive years. So we're talking about turnover, up to 15 million, gross assets 7.5 million, and average number of employees 50. So much, much bigger. So it may not impact. I'm not sure if any of the 2MC grantees will be impacted here, unless it be part of a much larger organisation. So it will rarely happen, I think. So now I'm going to move on to community benefit societies. So these are the non-charity ones, because the charity ones will follow the charity rules. Again, calculate gross income and assets, what type of accounts, and we've got the accruals accounts or cash-based, and again, what external scrutiny is required. And in this case, this is very similar to CICs in this particular calculation about gross income and non-charities. It's based on the useful life of the asset and spreading the income across that. And gross assets, same calculation, fixed assets plus current assets. And in terms of examples, quite similar to CIC really. In this case, year end 31st of March. And yeah, it's pretty much the same example, that income is spread over the useful life of the asset. And if the building is open partway through the financial year, then you have to proportion it in that financial year. Future years, you'll be looking at the whole year. And example 6, community benefits are exactly the same as before. In this case, 30th of June 2026, nothing to be included because the building wasn't open, because it's that building open date which is crucial. What type of accounts can you use with when you are a community benefit society, well, the general requirement is for them to use FRS 102, basically like the community responsibility. However, there is a provision that allows cash-based accounts, and the legislation talks about if it is very small, it's not required to follow an accrual framework, maybe because it's a government document or because of it meeting other thresholds and so on. But it doesn't say what is very small. Um, and so really comes down to a bit of judgment. But there are a few indicators you can look at. Um, Certainly, we'd be expecting it to be below, maybe significantly below 40 million, like hardly any assets and liabilities, very simple activities, few transactions, nothing complex or boring, and no requirement for an audit. So it's possible for some organizations to use cash accounts. In terms of external scrutiny for community benefit societies, we have basically two types here, unless an organization is very tiny. In which otherwise you have the accountant's report, which is for an income, the gross income of at least 90,000 in the preceding year. You look at the previous year, and if the income is not above 90,000, then an audit is not necessarily required. However, it's not automatic. There has to be a formal vote of members for audit exemption, and it only lasts 1 year. You can't say for the next 5 years or something. So it's an annual vote that you need to do, and audit. So if you're above 90,000, you need an accounts report unless you need an audit. And you can see the limits are a lot higher. They're the old Comfort thresholds, which haven't been increased yet. And so we're looking at turnover of 10.2 million and gross assets of 5.1 million. So these are the thresholds to look at for community benefit societies. What's the difference between the accountant's report and an audit? Well, I've talked about an audit before. It's positive assurance. It's quite a significant amount of work that goes into it. An accountant's report is very simple. It's much simpler, even with the independent examination. It's not really a high level of external scrutiny. It's basically where qualified accountants, qualified auditor is checking that the accounts and accounting records are consistent with each other, and that the community benefit society is complying with the requirements of the legislation. It's generally significantly less costly and intrusive than an audit. So I'm just going to finish off with just a few sort of slides here. I'm going to talk firstly about year-end preparation. So when you're coming to your year-end, you'll see in this table I've divided it between independent examination and an audit. Much of it the same. Bookkeeping, reconciliation, those keeping all your transactions up to date, reconciled, producing your reports, being able to explain any significant transactions and movements, and obviously break it down into restricted and unrestricted funds. That will be the same whichever version of external scrutiny you have. Grant agreements. Again, that's not going to be very different. You're going to need to have all your grant agreements ready and be able to demonstrate that you are meeting the grant conditions. Now, in terms of draft accounts, producing the year-end accounts, the trustees' annual report needs to be consistent with your accounts. But one of the things about independent examination is that the independent examiner can prepare the draft accounts if needed, and often will do for a smaller charity. But the trustees' report, the audit, and the audit requirements, the auditor is not allowed to prepare the draft account. So you need to be able to have someone or the ability to produce the draft accounts in-house, but the auditor can't do that directly. Sometimes an audit firm might have different departments and they can separate it out. In terms of board papers, minutes, and evidence of key decisions, if you're doing an independent examination, you need to have it available, especially major decisions. But with an audit, it's likely to be much more intrusive. They're going to be looking through it. They're going to be looking through your financial controls, your procedures, and different risks and how you manage it. And things like going concern, it's a requirement for trustees or directors to declare that it's a going concern. And the independent examiner might look at it and just see if there's anything that doesn't look right. But an auditor is going to go into a lot more detail. They're going to require a lot more information, cash flow forecast, business plans, and so on. So there's a lot more preparation that goes in. And then just to sort of a couple of slides to finish up. When you're doing your annual accounts, your annual report, think about who's reading your report. You know, who are your stakeholders? Who's looking at it? And from the diagram, the funders and local authorities are typically going to be the main users of your accounts, including Youth Investment Fund, DCMS, and your local authorities. Donors and members may well be, and the media, and so on. And you can see I put regulators in small at the bottom. They very rarely look at your accounts. So when you need to meet the requirements, but think of it as a document that's got to be, for your users. And when you're writing the trustees' report, think of it as a key communication document to your stakeholders. It's about the story of the charity. It's about how you're governed. It's about your financial performance, your reserves policy, and setting out that you've had. And the YIF grant will be the largest amount of income that you have. So when you're writing the trustees' reports, please think of how you're going to describe your project, how it furthers the overall objects and outcomes for the charity, and especially if you have an income above £500,000, it's required. But I would suggest, even if you're under 19, please set out, the sort of future plans of the charity, and particularly how the building is going to further. If it's not completed at your year end, then give some information on when it's opening, and progress on construction and so on, and also the overall final or estimated cost from funding. Really important. This is what users want to see, and often if it's going to impact your reserves or reserves policy, for many of you this is transformational, and users want to see the transformation that is happening. And just to finish off briefly about Charity Sort 26, I did do a whole webinar, which I think should be available for you to watch the recording on this. But this is a one-page summary. It is quite a bit of a change. And this is about the three-tier reporting regime. There's a lot more disclosures about future plans, sustainability, the volunteers in your organisation. Helpfully, the SORP does include prompt questions. So these are questions to go through to make sure and help you prepare the trustees' annual report. And the detail of the questions will depend upon what tier you're in. So the smallest tier, tier 1, will have fewer than say tier 2 and tier 3. There's an updated definition of reserves. It's more of a clarification, but it now specifically requires a reconciliation in the annual report. So the numbers in the balance sheet, how do they relate to your reserves, and some sort of reconciliation there. Two major issues around income recognition. So this is about contracts, could be local authority contracts for services, are now going to be based on fulfillment and delivery rather than on the sort of the activity that you might have at the moment. Again, these are complex areas, may or may not affect your organisation. There's also a few clarifications around what it talked about non-exchange income. So we're talking grants, donations, legacies. So it's not a two-way transaction. It's whoever's giving money is giving it and donating it to the organisation, not in return for some sort of service. It's not changing massively, but you will need to update your accounting policies and make sure that you are meeting the right requirements and disclosures. Then there's this new requirement for operational leases. So if you have a lease, then you might need to treat it as a fixed asset and put it on the balance sheet. Again, there's a complex area, especially if you have a peppercorn lease, then that's not counted here, so that's good. But if you have a low rent, say from a local authority, then you have to treat it part lease, part as a donation for the low rent. So these are really complex areas that you do need help. You need to be speaking to your accountant on that. Finally, the statement of cash flows, which is currently required for charities, 500,000 plus, that threshold can really up to 15 million. So that will make a little bit of work a little bit easier there. And just summarizing here, there is a table and there is a briefing note which sets out a lot of things I've already set out, and that's available for you as well.